Hiya and welcome to this video which introduces basic bookkeeping. The aim of this video is threefold. I intend to introduce the all-important equation that underpins the accounting world, the accounting equation. Following this, we will consider the dual concept and will end with the application of this through double entry bookkeeping. Now, you might recall from an earlier video that one of the branches of accounting involves recording transactions, and we do this via the process of bookkeeping. So let's start by considering the accounting equation and build towards this. So over onto the next page, I have noted the accounting equation. It's a simple formula and hopefully this equation makes sense. So it reads that assets, what the business owns, less liabilities, what the business owes, should equate to capital. And remember, capital is what is owed back to the owners of the business. Okay, so assets less your liabilities should equal capital, and capital is what is owed back to the owners. Now, assets less liabilities is often also referred to as net assets. Okay, so assets less your liabilities also gives us net assets, and that kind of makes sense because when you deduct everything that you owe to other third parties from the assets that you own, what you have left is a net amount of what you actually own. Okay, well, you can rearrange this formula so that it reads assets equals capital plus liabilities. Okay, so this simply is a rearrangement of the above. Now, you might find that you understand this second equation a little bit better because what we're saying here is that assets, what the business owns, is typically funded from capital amounts that investors put into the business and borrowings. Okay, liabilities, amounts that you owe to other third parties. So what the business owns, typically funded from capital and liabilities. What you might also have observed is that this second variation of the formula is precisely how the statement of financial position displays the elements. And remember, in an earlier video, we said that the elements are the items that are included in the financial statement. The phrase Alice I gave you as a mnemonic to remember the elements: assets, liabilities, income, capital, and expenses. Okay, and we see that in the SFP, assets are always presented first, and this is followed by capital and liabilities in the bottom section of the SFP. And it must always balance. In other words, the total assets must always equate to the total liabilities and capital. Double entry bookkeeping is actually built on this premise, and we'll see this later. Whilst we're talking about capital here, we can also think about capital as being calculated using the following formula. Okay, say my business is set up in the current year. Now, if my business is set up in the current year, opening capital, okay, should amount to nil because I've only just set up my business. If I invested £10,000 as I set up my business, that would be an example of a capital injection. So I'm going to note here £10,000 as a capital injection. We're adding it on here. Now let's say that during the year I withdrew about £5,000 for my own salary. Now these are referred to as drawings, amounts that are withdrawn by the owner for their own benefit. So I'm going to deduct here 5,000, and it makes sense to deduct this because this no longer is an amount that the business owes to the owner because they've already withdrawn the amount. So we're going to deduct. We always add on any profits that the business makes, okay, to capital, because essentially that's owed back to the owner of the business. So let's say I made a profit of £500 for my first year of trading. I would add on the £500 here. That profit is owed back to me as the owner of the business and forms part of the capital at year end. Say my business made a loss, I would deduct that loss. Okay, and it's a similar thing because it's my business. I've got to make good that loss, so it's got to be deducted here, and that's an amount that's going to be reducing the capital at year end. Okay, now if I total down here, I arrive at my closing capital. Okay, and that gives me 5,500 in my example here. Okay, so opening capital, add capital injections, less drawings, add profits, less any losses should equal the closing capital. And that closing capital is precisely what you should be seeing here in your accounting equation. Okay. In other words, the business owes me at the end of the year 5,500. Okay, so I've invested 10,000, withdrawn 5,000, but I've made a profit of 500, so that business owes it back to me because it is my business. Okay, now the opening capital for next year, okay, in my business would be the 5,500 that I've generated at the end of the current year. Okay, so that becomes opening capital for next year, so on and so forth. All right, so with that in mind, let's actually consider the dual concept. Okay, now the dual concept is simply the idea that for any given transaction, the two sides of the accounting equation must always hold true. Okay, the idea of dual does not imply that every transaction has got to have two entries. Okay, because what you'll learn is that actually often there are more than two entries to make for an accounting transaction. Okay, the idea of dual is simply that the accounting equation must always hold true. Okay, so both sides of the equation must always hold true. Now, I know it might seem a little bit confusing at first, so what we're going to do here is actually break it down using some examples. Okay, so I've got three transactions here, and we're going to work through each one in turn. And the way we're going to think about these transactions is in the form of what's increasing or decreasing in terms of the elements of the financial statements. Okay, so starting off with the first transaction, that KA invests £1,000 in her tuition business. Now, if we were considering this in the form of the accounting equation, what elements are changing? Now, hopefully you agree that investing £1,000 into the business would certainly be an increase to capital. And at the same time, that £1,000 is going to be banked into a bank account. Okay, so hopefully you also agree that that's going to be an increase to an asset, and specifically it's an increase to cash. Now, if I take that and populate it into the accounting equation below, which I've noted, assets minus liabilities equals capital, we've confirmed that assets are increasing by 1,000. Okay, and we also said that capital was increasing by 1,000. Okay, no impact on liabilities, and as we can see that by thinking about this in the form of increases or decreases, the accounting equation will hold true. Okay, remember the idea of dual doesn't also mean that there's got to be an increase and a decrease. No, okay, it simply means that both sides of the accounting equation must always hold true when we're thinking about describing a transaction in terms of the elements. Okay, so let's think about the next one. KA purchases a laptop for £400. Okay, so what is happening here? Well, purchasing a laptop is an item of property, plant and equipment. So we're clearly going to see an increase to an asset. Okay, and specifically that's going to be some item of PPE, property, plant or equipment. Now at the same time, paying for the purchase of the laptop is going to mean a reduction in your cash balance in your bank account. So there will be, in this example, a decrease to an asset, and that's obviously going to be your cash. So just like we did for transaction 1, let's take this transaction and populate it into our equation. So what's happening? Well, we are increasing our asset by 400, but then the withdrawal of the cash or the payment of the laptop in cash is reducing assets also by 400, which gives us an overall nil impact there to assets, no impact on liabilities, and again for this transaction, no impact on capital. But you can see again that the accounting equation holds true. Okay. Moving on to one more transaction, we'll consider this as the last one. Just so you get the hang of things. An idea here that a student pays £55 for an hour of tuition. Now, a student paying for tuition, considering that KA is setting up a tuition business, would imply that that is some sort of revenue or sale or income. When we think about the elements, income is an element of the financial statements. And as income increases, okay, you would see that profits would increase. Now, if we think back to the capital equation from the previous page, any increases to profits increases capital. So hopefully you'll agree then that this £55 income from providing tuition would increase the capital. Okay, so I'm just going to say here there's an increase to capital, and it's because of the increase in income, which in turn increases profits. Okay, and profits, as we've seen, increases capital. The other branch of this transaction is that if the student is going to pay you for tuition, that's probably going to be in the form of cash, okay, coming into your bank account. So that's going to increase also an asset, and specifically cash, okay. So just like we've done for the previous two transactions, let's take that into our accounting equation. So we know that assets are going to increase by 55, no impact on liabilities, but we have said that capital will increase by 55, and there you have it, the accounting equation holds true again. Now, this is the first step to understanding the language of accounting, really being able to describe transactions in the form of movements and changes to the elements of the financial statements. Now, what we'll learn on to the next page is how we can start to use alternative phrasing or accounting specific language to see how we record these transactions. Okay, so instead of using the phrase increase or decrease in elements, we're going to be using accounting specific jargon. Right. So hope you're ready. Onto this page, we are seeing here a mnemonic that you can use that will really help you cement the accounting language for recording transactions. Now, the phrase that we've got here on this screen sounds a lot more dire than it really is. But I promise you that if you can learn this mnemonic and learn it well, it will make recording transactions for you as easy as breathing. Okay, so let's break this down. We've got the phrase dead click. Okay, so what does it stand for? Well, starting with the word dead first, okay, we've got the D, which stands for debit. Okay, and that is an accounting term that we use whenever we are thinking about increases in expenses, assets, and drawings. Okay, remember expenses and assets are elements that we've spoken about in an earlier video. Drawings I've separated out here because drawings are an example of a reduction to capital. Okay, if you think back to the capital equation, drawings, amounts withdrawn by the owner, are deducted from capital. From an accounting perspective, we like to maintain a separate record of this. So while drawings wasn't part of the main elements that we covered in an earlier video, okay, when we think about actually recording the transaction, we do maintain a separate account for it. Okay, so debit for increases in expenses, assets, and drawings. That's what the dead stands for. What about the click? Well, the click stands for credit, okay, and credit is the accounting specific jargon that you will use for increases in capital, liabilities, and income. Okay, so for increases in capital, liabilities, and income, you're going to use the phrase credit. Okay. Now, in a similar manner, we can think about decreases in expenses, assets, and drawings by using the phrase credit. Okay, so it's not as simple as saying debit will always mean an increase and credit will always mean a decrease. No, because as you see, a credit is also used for increases in capital, liabilities, and income, but it's also for decreases in expenses, assets, and drawings. Okay. We use the phrase debit for decreases in capital, liabilities, and income. So here's the thing. If you can remember that phrase dead click, which applies to terminology that you use for increases, the opposite is also true. Okay, so debit for increases in expenses, assets, drawings, but equally, if you want to reduce expenses, assets, and drawings, you use the phrase credit. Okay, and a similar thing for the word click. Admittedly, this is going to take a bit of time to stick, but I promise with a bit of practice, you are going to fall in love with dead click, or at least I hope so. Let's practice this using some transactions to really help you conceptualize this, okay? So over onto the next page, I've noted again those transactions that we covered when we were simply thinking about, KA and her tuition business in the form of increases and decreases. Okay, now what we're going to do is take those phrases and actually use the accounting specific language. Okay, so instead of using increases and decreases, let's turn those into debits and credits and start thinking about accounting jargon. Okay. So earlier we had KA investing £1,000 in her tuition business, and we all agreed that that would be an increase to an asset and an increase to capital. Okay, obviously that £1,000 being banked in her business bank account. So applying dead click, and let's just write it here on the side. Okay, so we've got a reminder. If we want to increase an asset, okay, we want to increase an asset. Okay, we've got the A there. For increases in an asset, we use the phrase debit. Now, debit is often abbreviated as DR. Okay, so debit, we're going to say cash. And I'm using the phrase cash, I'm being a bit specific with the account, the asset account that is increasing. Okay, so we're going to say debit cash, and that's going to be 1,000. We also said that there'll be an increase to capital. Okay, and if we think about dead click, we've got the C there for capital. We use the phrase credit, okay, to increase capital. So let's use CR as the abbreviation for credit, and I'm going to say credit capital 1,000. Okay, now here's another little accounting rule. For every transaction that you record, the debits and credits must always total. Okay, and that's another way of checking that the dual concept will always hold true. Okay, remember the idea of the dual concept is that the accounting equation must always hold true. Okay, so a little sense check here. Do we have a debit and credit that amounts to the same? Yes, we do. Okay, the 1,000. In a very similar way, let's think about the second transaction, the purchase of the laptop. And we agreed that the purchase of the laptop for £400 was an increase to an asset, but at the same time, it was a decrease to an asset because the payment would be in cash. So applying dead click, okay, we need to increase an asset. Okay, so again, we've got the A there. To increase an asset, we debit. So I'm going to say debit, and I'm going to be specific. Okay, in accounting, although we have 5 generalized elements, we do, when we record transactions, try and be a bit more specific and detailed with what type of asset, what type of liability. Okay, so here we've got an item of PPE, so I'm going to say debit, an increase in property, plant and equipment to the value of 400, and equally there's a reduction in cash, so I'm going to credit and therefore reduce cash 400. Okay, let's just take a moment to really understand that. Yes, we debit for increases in an asset. Cash is actually decreasing, and we did say the opposite is true in terms of the phrasing that you use. To reduce an asset, okay, you would use the phrase credit. Or another way you could look at this, because we've said that for every transaction there must be a debit and credit that totals the same amount. An easy way to think of this is that, well, if you've got a debit here 400, the other side of the transaction has got to be a credit. Okay, and again, you can see that the debit amounts and the credit amounts, they do total the same. Which brings us on to the final transaction. Now, with this final transaction, we sort of said that £55 income or revenue increases profits, which increases capital. Okay, and what I've tried to do here in terms of thinking about the movement is I've been specific by saying it's an increase to income. If we think back to our increases and decreases, yes, we said increase to capital. If we're going to be specific when we're noting the detail of a transaction, it is an income. Okay, so we are going to start off by saying that's money coming into the business. So we're going to debit and therefore increase cash 55. Okay, and it's an increase to income. Okay, and if we apply dead click, there you have it. The I stands for income. To increase income or to even increase capital, you're always crediting. Okay, so we're going to use here the CR to income, credit income 55. Okay, and we can see again that the debits and credits total. Now, I know that might take you a moment or two to really understand, but if you're listening into this video and thinking, oh my God, is it as simple as that? I can tell you that it is. Yes, we do build on this by adding complexity to accounting transactions, but this is the skeleton of accounting. And if you understand this, you are onto a win. Right, that's it for this really short video. Hopefully you found it useful. What we did is we started off by introducing the accounting equation. Okay, and we said that the accounting equation is assets less your liabilities equals your capital. We then moved on to cover the dual concept. The idea of the dual concept is that the accounting equation, both sides must always hold true. And the final bit of this video was really the application of the dual concept by considering a bit of bookkeeping, the recording of transactions by using the mnemonic dead click. Hopefully you found this video useful. I look forward to having you listen in for the next one.